Welcome back to Gold Rush Reporter, your trusted source for clear and accurate updates from the world of gold and silver. I'm your host, Conrad, and today we're starting with something that has become almost routine lately: silver breaking another all-time high. Yes, once again, silver pushed up to around 59.33, setting a fresh historic level before experiencing a small pullback. But don't go anywhere, because what's happening right now is not just price action. It's a signal, a big one. And if you follow gold and silver closely, you already know that these movements are rarely random. Every time silver explodes upward, people get excited. And every time it eases down a bit afterward, people get scared. But the real question is, should you worry about these dips or understand them? Before we break this down, make sure you like this video, subscribe, and hit the bell icon so you never miss your daily gold and silver updates from the Gold Rush Reporter team. Now let's dive deeper. Silver reached another record high, and just like we've seen many times before, a pullback followed. As of the moment I'm recording this report, silver is sitting near 58.40. It sounds almost funny calling $58 silver a pullback, but technically, that's what it is. Many new viewers often panic during these dips, thinking something major is going wrong. But what we're actually seeing is a normal market behavior. Prices rise quickly, momentum cools down, and the chart resets before deciding the next direction. One of the simplest ways to understand this is with a basic example. Imagine you go to a store to buy a pair of shoes. One day they're full price, and next week they're on sale. You don't get scared when the price drops. You simply see it as a discount. But in precious metals, people react differently. When the price is high, they celebrate. But when the price falls a little, suddenly it feels scary, even though it's just normal market breathing. This emotional cycle keeps repeating. Silver climbs, people get hyped. Silver dips, people worry. Then silver rises again, usually higher than before, and people say, "Why didn't I take that dip seriously?" What's important right now is not panic, but understanding the pattern. And today's movement fits perfectly into that long-term picture. Now that we've set the stage with silver's latest movements, it's time to dive deeper into what's driving these changes. Silver isn't just moving because of short-term hype. There are bigger, structural forces at work. One of the key stories is the shift in global physical demand. Recent reports suggest that major silver holders in the West are increasingly redirecting their metal to Asia, especially hubs like Singapore. This is significant because these markets are hungry for real, physical silver, not just paper contracts or derivatives. For years, big institutions in the West, including banks like JP Morgan, relied on paper-based strategies to influence prices. They used cheap funding and large-scale contracts to manage supply and keep prices under control. It worked for a long time when demand was moderate and interest rates were low. But today, everything is changing. Interest rates are rising, industrial demand is surging, and supply is not keeping pace. Industries like solar, electronics, and green technology require silver, and they will buy no matter what the price is. This is what makes silver inelastic. Real demand doesn't disappear when prices pull back. So, when silver dips slightly after a record high, it's not a reason to panic. It's a buying opportunity. Think of it like a store sale. The discount is temporary, but the value remains. This cycle of highs and pullbacks has repeated for decades, and each time, the next rally usually surpasses the previous peak. Institutional behavior also plays a critical role. Shifts toward Asian physical markets indicate a long-term redistribution of silver supply. Western banks are quietly adapting, moving their bullion closer to regions with real physical demand, essentially front-running where price discovery is becoming more transparent. At the same time, supply pressures are intensifying. Above-ground reserves are limited, mining production cannot immediately expand, and annual deficits continue to grow. Analysts predicted years ago that silver would eventually break out around 2025-2026, and current market activity is confirming those forecasts. In short, silver is in a critical phase. Pullbacks are normal, but underlying forces, rising industrial demand, shifting global supply, and institutional movements are setting the stage for potentially historic price growth. Continuing from our last discussion, let's take a closer look at the supply-demand imbalance that is driving silver's price higher. Understanding this is crucial for anyone following the market seriously. First, let's talk about physical supply. Unlike gold, silver's market is much smaller, which makes it more vulnerable to shifts in demand. Above-ground reserves are limited, and mining production cannot expand quickly. Industrial demand, particularly from solar panels, electronics, and new green technologies, is rising sharply every year. When demand rises faster than supply, the result is a natural upward pressure on prices. Second, consider the role of major institutions. Western banks, including giants like JP Morgan, Wells Fargo, and Citigroup, have historically relied on paper contracts to manage the silver market. This approach works only as long as they can control supply and demand perception. But now, physical demand in Asia is growing rapidly, and Western banks are quietly moving bullion closer to these markets. This is a strategic pivot, a shift toward regions where real silver exists and true price discovery is taking place. The combination of shrinking supply and rising demand creates a powerful market signal. Pullbacks after record highs are part of the normal cycle, but they do not change the underlying trend. Think of it as a spring being compressed. The more pressure builds, the stronger the eventual move upward will be. Another key factor is industrial consumption versus investment demand. Unlike gold, which is mostly held as investment or reserve, silver has enormous industrial applications. Each year, billions of ounces are consumed in technology, solar panels, and electronics. And even as prices rise, this demand does not decrease significantly. That makes silver particularly sensitive to supply constraints and shifts in ownership. Additionally, speculation and market strategies continue to influence price movements. Paper contracts, futures, and hedging activities create short-term volatility. But as more physical silver moves to markets with actual demand, these short-term fluctuations are less important than the long-term fundamentals. In essence, what we are witnessing is a major transition. Western financial centers are losing control of the market, and physical silver is being concentrated where it is most needed. Every dip is a chance to buy at a relative discount, but the long-term trend remains clear. Demand exceeds supply, and silver's price is being pushed higher. Now that we've analyzed the supply-demand imbalance, let's turn our focus to central banks, regulatory events, and institutional strategies. The behind-the-scenes forces that often move silver prices before the public even notices. Major institutions like JP Morgan, Citigroup, and Wells Fargo have historically played a significant role in the silver market. They've relied on paper contracts, futures, and hedging to influence price movements. While these strategies create short-term volatility, they are not a reflection of the real physical demand. Understanding their actions helps us anticipate potential market shifts. Take the COMEX system, for example. On several occasions, trading halts and sudden adjustments in contracts have made headlines, but the underlying story is usually more complex. Sometimes, a pause in trading is used to prevent a market imbalance from spiraling out of control. Large institutions may quietly shift billions of dollars worth of contracts to avoid physical delivery crises. While this can temporarily suppress prices, it doesn't change the fundamental scarcity of silver. Another factor to consider is the geographical redistribution of silver. As Part 3 discussed, more physical silver is moving toward Asian markets, where real demand is growing rapidly. Western banks are strategically positioning themselves closer to these regions, preparing for a long-term shift in where silver prices are determined. This is a critical move because price discovery occurs where physical metal is actively traded. We also need to talk about market manipulation and regulation. In the past, major banks were fined for activities like price spoofing, yet these events highlight an important point. Even when regulations exist, they can only partially control the market. The true drivers of silver prices remain supply scarcity and physical demand. For investors, this creates both opportunity and risk. Short-term price dips can appear alarming, but they often represent a chance to acquire silver at a slight discount. Meanwhile, long-term trends, rising industrial demand, diminishing physical reserves, and strategic moves by major institutions strongly suggest that silver's value is poised to grow significantly. Lastly, it's important to remember the human behavior aspect. Investors frequently react emotionally to market fluctuations. Understanding the broader economic and strategic context helps you make rational decisions instead of following fear or hype. As we continue our deep dive, it's time to explore historical patterns in silver pricing and how past events can help us understand today's market. History often repeats itself, especially in precious metals, and silver provides some of the clearest examples. Let's start with some key historical moments. In the 1930s, the US government passed Executive Order 6102 and later 6814, which required citizens to surrender gold and silver. These actions drastically reduced private holdings and allowed authorities to control the market. Fast forward to the 1970s and 1980s, the Hunt brothers attempted to corner the silver market, driving prices to record highs. The government then intervened to prevent further manipulation. These events illustrate a critical point. Supply shocks and regulatory interventions can temporarily distort silver prices, but they don't change the underlying value of the metal. Scarcity, industrial demand, and global interest always reassert themselves over time. More recently, from 2008 to 2011, silver surged past $50 per ounce, reflecting both increased investment interest and industrial demand. Even though the price pulled back afterward, those who understood the long-term fundamentals recognized this as a temporary correction, not a market collapse. Today, we are seeing similar patterns play out. Western markets face limited physical silver availability, while Eastern markets are hungry for real metal. Large institutions are quietly reallocating bullion closer to these high-demand areas, preparing for the next phase of price discovery. It's also important to note the role of industrial growth. Silver isn't just an investment. It's an essential material for technology and green energy solutions. Solar panels, electric vehicles, and electronics rely heavily on silver, and this demand continues to climb. Each year, billions of ounces are consumed in manufacturing, further tightening the supply available for investors. For serious analysts, these historical and industrial factors provide a roadmap for anticipating future price moves. When supply is constrained, demand is rising, and strategic players are repositioning. The next significant price surge becomes not a question of if, but when. In essence, silver behaves like a slow-building pressure system. Each historical event, each regulatory move, and each industrial trend adds to the overall momentum. Pullbacks may occur, but the long-term trajectory remains strong. We've seen how supply constraints, rising industrial demand, and strategic institutional shifts are creating a unique environment for silver. Pullbacks are normal, but the long-term trajectory is clear. Physical demand is growing, reserves are limited, and price discovery is moving toward markets that value real metal. One key trend to watch is the Asian physical silver market. More bullion is moving to regions like Singapore and China, where investors and industries rely on actual silver rather than paper contracts. This shift represents a major redistribution of market power, signaling that Western dominance in pricing is weakening. Another factor is government and central bank actions. While regulatory measures can create short-term volatility, they cannot change the fundamentals. Silver is scarce, industrial demand is increasing, and global interest in precious metals is stronger than ever. Investors should also pay attention to technological trends. Silver is critical for solar panels, electronics, and green energy solutions. As the world moves toward a more digital and sustainable economy, industrial demand will continue to rise, putting upward pressure on prices. So, what does this mean for you as an investor or enthusiast? First, don't panic during minor pullbacks. These are part of the market's normal rhythm. Think of them as opportunities to acquire silver at relatively lower prices. Second, focus on the long-term fundamentals: physical availability, global demand, and institutional positioning. These forces drive the market far more than short-term fluctuations. Finally, it's essential to understand the human factor. Emotional reactions can lead to poor decisions. Instead, follow the facts, track market trends, and keep an eye on both global industrial needs and institutional moves. Knowledge is your best tool for making rational, informed decisions. To summarize everything we've covered across these 6 parts: silver continues to break records, but pullbacks are normal. Global demand, especially from Asia, is reshaping the market. Supply constraints and industrial needs are increasing long-term pressure on prices. Strategic moves by major institutions indicate where the next major shifts may occur. Historical patterns show that markets may fluctuate, but fundamentals always prevail. As always, here at Gold Rush Reporter, our goal is to give you clear, professional insights so you can navigate the gold and silver markets with confidence. Keep tracking these trends, stay informed, and approach every market movement with the perspective of a long-term analyst. That wraps up our detailed analysis. Stay tuned for daily updates and insights. The market is moving fast, and being informed is the best advantage you can have.